In this video, I want to share with you another losing trade, a trade that we had in Amazon. Now, you might be sitting there wondering to yourself, why is this guy talking about his losses? Nobody talks about their losses. Everybody's a winner when they go into the stock market, and I want to follow people that win consistently in the stock market. What you want to be able to do, and what I've learned to be able to do, is that you do want to follow consistent success in the stock market. That does not mean having a very high winning percentage. You don't need 100% winning percentage to win in the stock market. You don't need a 70% winning percentage to win in the stock market. I was able to triple the return of the S&P 500 with a win rate of about 40% in 2017. The way that I was able to do that was by allowing the winners that I had to run for as far and as long as they were able to run, and by cutting my losers very, very quickly. And so by doing that, my winning trades were dramatically bigger than my losing trades. And that, my friends, is the equation to winning in the stock market. And so I want to share with you one of the losing trades. And the losing trade was in Amazon. So let's walk through that trade step by step, and I'll show you why we exited, when we exited, and how this trade fits into the overall bigger process of what actually allowed us to win in 2017 and triple the return of the S&P 500, generating roughly 60% for the year. So here is a daily and weekly chart of Amazon. So you can see that we entered on September 13th at $996.38 right here as it was breaking back above the 50-day moving average, and we ended up exiting only a few days later at $954.56 on September 22nd. And that was the third time that we traded Amazon. We lost a little bit on the first trade, made a little bit on the second trade, and now we ended up losing a little bit more on this third trade. So we ended up exiting pretty quickly, and that was basically it. Like, we saw it rallying back above the 50-day moving average, and that idea, it did not hold this level over here, right? So it didn't hold that 100-day moving average, that shorter term moving average or support over there, and it continued to consolidate. And the model portfolio did not get back into Amazon at all, which you might look at this and see what Amazon ended up doing and think that that was a mistake, and that if we did end up getting back in on this rally over here, then you would have made 60% on the trade. Could have, would have, should have, but we didn't. And so what did we actually end up doing? So if we go back over here and we look at all the trades and what we were doing, you can see that we weren't just like sitting around. We ended up going into other trades that perhaps looked more attractive at the time, and the trades that Adam Sarhan ends up picking. He's the one that actually picks all of the trades for this model portfolio, and I'm following along trade for trade just like you guys, and it's something that allows me to be able to take advantage of this intermediate term time frame and learn right along with you. I'm more of a shorter term swing trader by nature and by my own trading psychology. That's something that I figured out just through my experience and through going through my past trades and meditation and all of that. And so I wanted to get better at holding for the longer term and being able to do that. You're not always going to catch every single big move. So the most important thing that I've learned through Adam and following this model portfolio is that if you have a thesis and you put that thesis to work, you want to exit as quickly as possible when your thesis is broken. So going back over here on that entry, if you're just looking at it on this day, and you see that it's starting to round out a little bit, could be considered maybe a cup pattern in the making, and it's breaking above the 50-day. Okay, now my expectation would be that it would continue to rally higher and at least hold this level down here, which is the 100-day moving average. And yeah, that's a shorter term level of support, but the 100-day moving average is obviously a longer term or more intermediate to longer term moving average. And when it fails, okay, so then that thesis is broken, time to exit the trade. Could we have gotten in back there, or would it have made sense to? Arguably, but now you're kind of like getting into that choppy zone where like, can it work? Will it not work? If you bought right there as it came back in, then it starts to come back against you, and you're probably exiting if you're getting in back over here and then it's falling back below that point over there. Are you going to necessarily hold through the earnings announcement if you're just getting in back on this? Probably not. Holding through earnings really takes a lot of where are you in the position at that point. If you're somebody that got in way back here and held it for the duration, then you're sitting on a much larger cushion. And so then it becomes a matter of how much of your profit are you willing to give back versus somebody that's entered right over here, and then it's, well, I intended to risk this much, but if earnings are poor, then I could end up losing dramatically more than I had intended to risk. So that's why it's difficult for most people to sit through earnings. Now, there's a lot of advanced strategies on how to play earnings with options and how to mitigate risk with options, but I think that that's a little bit out of the scope of what we're talking about here. It's more about this particular trade in Amazon and how we handled it and how it fits into the overall scheme of the portfolio. So with the idea of being able to exit very quickly and be able to reallocate and manage the position as a whole, it's important to look at your portfolio risk and to be able to understand that that's just one instance of a trade. We're not trying to make a huge gain on Amazon, or we're not trying to make a huge gain on any one of these individual trades. What we're trying to do is incorporate a process that we know over time works. So we don't know which one of these trades is going to be the big winner. If you asked me at the beginning of January when we initiated trades in Adobe and Alibaba, and we saw the way that Alibaba was going and the way that Adobe was going, I thought that Alibaba would have been our bigger trade, and it wasn't. Well, we ended up exiting Alibaba with roughly an 80% gain when it started to consolidate, and Adobe we're actually still sitting in, and at this point it's up over roughly 100%, and well, we've been in it for well over a year. January 2017, now it is April 2018. So you never know which stock is going to be that big winner. It could surprise you. And you never know which one is going to end up not working out either. What we need to do is allow the market to tell us which ideas are right and which ideas are wrong, and to be very humble in that and to check our egos at the door. So I think that that's what it boils down to, having a solid process, checking our egos at the door, and letting the process work. So I hope that makes sense, and I hope that you got a lot out of this video. Let me know what you thought about it. Leave it down in the comment section below. If you have any questions on anything that I said in this video, please leave that down in the comment section below as well, and I will personally help you. Also, if you like this video, click that thumbs up button. That always helps us out a lot. And make sure that you subscribe to the channel so that way you get every single update. Thanks again for watching, and I'll see you again in the next video. Take care, and have a great day.